My name is Jim Weisel, Professor of Accountancy at Georgia Gwinnett College. In this video, I'm going to demonstrate how to account for the income tax issues related to net operating losses. And the exercise from your textbook that I'm going to use as an illustration is exercise 1620. I'm going to switch over here to the textbook for a moment. In exercise 1620, we have Baginski Steel Corporation, and they reported a loss of $375,000 for financial reporting and tax purposes. So in other words, we don't have to deal specifically with any permanent differences or any other temporary differences like depreciation and warranty expense and all that other stuff. So the only issue that we have to deal with here is the fact that they had an operating loss. And the question is, how do we go about dealing with that operating loss and recognizing it for income tax purposes? So here is the fundamental issue that you need to understand. An operating loss is basically going to be treated conceptually the same as any other deferred tax asset. So an operating loss is going to result in a deferred tax asset. And so you would follow the rules or the conceptual issues related to deferred tax assets. Essentially what happens here is the IRS does not allow us to record or recognize a loss on the income tax return. The IRS will allow operating income to be zero, but will not permit a business entity to have an actual negative taxable income. Even if the operating loss is generated on the GAAP income statement, we simply can't have negative income on the tax return. We can have zero, but not negative. What that means then is that if we have an operating loss from a GAAP standpoint, then we will probably have to carry that loss into or two different periods. The general rule for recognizing operating losses is you can take it back 2 years. You can carry back losses 2 years if you so choose and refile a tax return and perhaps get a refund. Or you can carry the operating loss forward, and the operating loss carry forward limitation right now is 20 years. So in essence, you have a firm has 22 years, 2 years from previous periods and up to 20 years into the future for recognizing that operating loss or getting the so-called tax benefits of an operating loss. So let's talk about how this would apply specifically to Baginski Steel. And I'm going to switch back here to the case. And what I'm going to do here is let's assume that we have that $375,000 loss. And so I'm going to go ahead and follow the same process. Even though we're specifically dealing with net operating loss here, you want to follow the exact same process, the exact same organization of data that we've been doing all along. So we have a GAAP income or loss of $375,000. There are no permanent differences discussed in the particular problem, and so our adjusted GAAP income or loss in this case, is $375,000. Remember that the adjusted GAAP income or loss is going to be used as the basis for determining our income tax expense. Now we'll get to that in just a moment. Remember, however, the rule is, the IRS rule is that although you can have zero taxable income, you cannot have negative taxable income. And right now, our income is negative, which means that we have to have an addition here in order to arrive at taxable income. Whatever our loss is for this year, we're going to add that back in our reconciliation. We're going to add that back, and that's going to create a deferred tax asset. In other words, we are not going to be paying any income taxes this year, but we will get the benefit of that loss in future periods. It is essentially like having an expense that is not recognizable for this year for tax purposes and has to be delayed into future time periods. Now, for purposes of Baginski Steel, we are not going to deal with the potential of a carry back. We're just going to look at the carry forward situation just so that you can get the basic concept down here. All right, so here's what's happened. From a reconciliation standpoint, we have $375,000 loss for GAAP purposes. That's going to still be used to determine our income tax expense. And we have taxable income of $0, which is still going to be used as our basis for determining the income tax payable. Now clearly 0 multiplied by whatever our tax rate is means that our income tax payable this year is going to be 0. So let's take a look and see what happens with the journal entry. The journal entry is a little bit odd in that we definitely have a debit to a deferred tax asset here for the operating loss carry forward, $375,000 times 40%. So the income tax benefit of having a $375,000 loss is $150,000 of future tax benefit that we'll get. And I mentioned or indicated that the adjusted GAAP income or loss is going to still be used as a basis for determining our income tax expense. Here's where things get a little bit strange looking, although from a conceptual standpoint this is perfectly correct. Instead of having an income tax expense, we would essentially have a negative income tax expense, right? A loss times a tax rate would be a negative income tax expense, and that is going to be treated or recorded as income tax benefit. We normally don't have negative expenses showing up on the GAAP income statement, and so instead what we have is an income tax benefit. Notice here that there is no current income tax payable. Income tax payable is 0. 0 taxable income times the tax rate is still 0. So we don't have any income tax payable in the current year. All we have is the deferred tax asset that's being created. That's based on the addition in our reconciliation. And then what is in effect a negative income tax expense, or what is called income tax benefit. Again, we normally don't have negative expense accounts, and in this particular case that shows up as an income tax benefit. So from a balance sheet disclosure, we have this deferred tax asset, which is $150,000. That's what we just created on the balance sheet. Probably listed as a non-current asset, although again that would be up to management's discretion as to when we think we'll be able to use up that benefit. And then our GAAP income statement is going to show a net loss of $225,000. We have a $375,000 operating loss plus the income tax benefit, that negative income tax expense. So we're adding back to our operating loss, or reducing our operating loss, because of this income tax benefit that we will be receiving at some point in the future. So the GAAP income statement is going to show a net loss of $225,000. Okay, so let's move on. I want to extend this now, move on to 2014. And let's presume that in 2014 that the company's operations improved and they managed to generate a GAAP operating income of $100,000. All right, so what do we do now with that $100,000 in 2014? Well, again, we follow the same pattern as we normally do. GAAP income is 0. We don't have any permanent differences. Adjusted GAAP income or loss is $100,000. In this case, it's income of $100,000. And here's where we begin to make use of that operating loss carry forward. We have an operating loss carry forward of $375,000. So here's where we are going to begin to draw down on that deferred tax asset, begin to use up some of that loss. Now in 2014, we can't use up all of it, because we only have $100,000 of GAAP income. Remember, no matter what, taxable income cannot be negative. It can be zero, but it cannot be negative. So if we have adjusted GAAP income of $100,000, then we get to basically use up $100,000 of that $375,000 loss carry forward. So again, in 2014, our taxable income is zero. We still have no income tax payable. Now we just keep following the exact same pattern that we've been talking about here for several weeks. Adjusted GAAP income is the basis of our income tax expense. Taxable income is the basis of our income tax payable. And then we deal with, in this particular case, the reduction of a deferred tax asset. So the journal entry is going to look pretty simple. Our income tax expense is $40,000. That's $100,000 of income multiplied by 40%. And then instead of paying that this year, we are going to use up some of that loss that we're carrying forward. That's the benefit, such as it is, of having an operating loss. So our deferred tax asset is going to get reduced by $40,000. We established that last year with a $150,000 balance, and now we get to use up a portion of it, $40,000 this year. That means on the balance sheet now, our deferred tax asset has a balance of $110,000, and our income statement is going to show a net income of $60,000. Even though we didn't have to pay in the form of cash any income taxes this year, there is an income tax expense associated with having an operating income. So that would be what happens in 2014, assuming, of course, that we have a $100,000 income. So now what's happened here is our operating loss carry forward, not the deferred tax asset account, but the operating loss carry forward now has a remaining balance of $275,000. We started out with a balance of $375,000. We used up $100,000 this year. So let's see what happens in 2015. And let's say that in 2015, our GAAP income now has really improved, and it was $300,000. So we have our adjusted GAAP income. Again, we don't have any permanent differences in this problem, so that's still $300,000. Remember that we have $275,000 operating loss that's being carried forward. We created it in 2013 at $375,000. We used up $100,000 of that in 2014. That means that we have a remaining $275,000. So now we'll subtract that from our GAAP income to arrive at taxable income of $25,000. That will use up the remaining portion of our operating loss carry forward. And now we go through the exact same process again in terms of a journal entry. In 2015, we actually do owe some taxes this year, only $10,000. But you can see, most importantly, we're following the same pattern that we follow all the time. GAAP income is the basis of our income tax expense. Taxable income is the basis of our income tax payable. And then the debit or credit to a deferred tax asset account or deferred tax liability account is the balancing element to the journal entry. So in this case, in 2015, income tax expense is $120,000, income tax payable is only $10,000, and we use up the remaining balance of our deferred tax asset. Remember, we created it with a $150,000 balance in 2013, used up $40,000 of that in 2014, and now we use up the remaining portion in 2015. And so we have no deferred tax asset remaining anymore. Technically, I suppose we could list that as zero, but most firms will just simply not include it on the balance sheet at all if it is a balance of zero. Our current liability now, unlike in previous years, we do have a current liability because we do have income tax payable. We do owe this year $10,000. And so our Income statement then, the last element here, would show $180,000 of net income. GAAP income of $300,000 minus our income tax expense of $120,000, and that's $180,000 of net income. So what's happened over the entire 3-year time frame is we've used up now that $375,000 initial operating loss. The key to understanding how to deal with the carry forward of an operating loss is to understand that an operating loss is going to create initially a deferred tax asset. If you can remember that, then you can put the remaining pieces of the puzzle together following the exact same logic, the exact same pattern in terms of reconciling GAAP income to taxable income that we've been doing all along. Hope this helps with the deferred tax asset and in particular recognition of operating losses on a GAAP income statement.